All three of us, so Elijah, John, and myself, we're very excited to be here today and to speak to all of you. As we go through this, though, feel free to interrupt us at any point at any time if you have any questions. We're happy to really take this conversation where it's most impactful to you. And also at the end of the presentation, we did put down our contact information. So if a question comes to you later, or if you're not sure it's an appropriate time, please do feel free. Elijah and myself, we resonate in Portland. And so not only are we stakeholders of RVK College, but we're very interested in both your success as well as the successes of Portland. Today, what we really hope to speak to you about is regarding investment consulting, mostly on the institutional side. Before I do that, though, let me give a second for both Elijah and John to introduce themselves. I'll start with John. John's out of our New York office. He's a recent graduate and also a member of our consulting team within RVK.
Yeah, thanks, Jason. So I was an urban studies major in college, but I ended up studying a little bit, getting my feet wet with like real estate in the business school at the University of Pennsylvania. And then from there, I ended up working for a pension fund. And after that experience, I wanted to see more institutional investors and get more exposure. So I ended up joining RVK, and that was in January of last year. So I'm a little over a year at RVK now.
Elijah is a member of our manager research team. He does have his slides later on will go into a little bit more detail regarding his day-to-day activities. But Elijah, if you just want to give a brief introduction overview of how you came to RVK.
Yeah. My name's Elijah. Nice to meet you all over Zoom. I graduated from Oregon State University in finance with a minor in econ. And I was in the Oregon State Investment Group there, which is kind of a college club that managed a portion of the endowment assets and invested in simple stocks. So that was kind of my introduction to finance. It was really interesting. And, when I was looking for a job in finance, I kind of stumbled across institutional investment consulting, which I had never heard of. And I doubt any of you have heard of before maybe this Zoom call. So it was really interesting. I started in the PMA department, which is our analyst pool. And then I moved to the manager research side of things. And you can generally go one of two ways. You can go general consulting, where Jason sits, or you can go the manager research side, where you're kind of a resource to both clients and the consulting team, and you do manager due diligence among many other things. So that's where I reside.
Thank you, and I'll give my brief introduction. So probably as the oldest member of this call, really my career started within the asset management field. I started out as an equity and a fixed income analyst. Back then, we had Excel, but we didn't have all the cool VBAs and macros that are now available. So a lot of my work was doing quantitative as well as qualitative analysis of fixed income. And that included looking at covenants, looking at prospects, talking to clients, but also recommending investments. And I came into the institutional consulting world about 20 years ago. And really what drew me to it was both, there is a quantitative aspect into it, and we'll get into that just a little bit later, but there's also a heavy qualitative aspect. So it's one thing to be able to come up with a recommendation. It's another way to frame what that recommendation is and to come up with a message that's appealing to the client as a way to really help guide them. Now, institutional consulting, for those of you who are not familiar with it, as you can see on this slide here, really it involves working with any sort of entity that has a pool of assets. And with those pool of assets, they both have current obligations as well as long-term obligations. And for the most part, they'll tell someone, look, we know you're a member of our staff right now, you're looking to retire probably in 20, 25 years. We're going to provide for you that safe and secure retirement. And what we're going to do is we're going to set money aside. Now, we're not going to fund that 100%. We're going to fund it about 80%. And what our hope is, through investments, we're able to grow those assets in order to make sure that that we have all the money that we promised you when you are looking to draw it down. Now, as I mentioned earlier, institutional consulting both has a quantitative side, and really that genesis started back in the 1950s by a professor, Dr. Markowitz. He came up with what's known as the modern portfolio theory. And really what that theory distills down to is being able to quantitatively look at asset classes and more distill them into numbers. And by distilling them into numbers, being able to say, look, if we were to create this combination or basket of asset classes, how can we produce the highest possible return for the level of risk that a client is undertaking? Now, that was used as the guiding post all the way up into 1964. At that point, another professor, William Sharp, who is still a practitioner today, came up saying, look, well, you should hold this diversified portfolio of assets and always been influenced regarding the projected rate of return and the level of risk, but also think about the investor preference as well. How can we come up with that basket of assets that produces what's known as the Sharpe ratio or the risk return ratio, the way that maximizes that ratio in order to create the most optimal portfolio for that client? Now, as you mentioned, I said for that client, and the reason why is every single client is different. Their risk tolerances are different. The return objectives or what they hope to earn through their bundle of assets is different, as well as their governance is different. And so not just the quantitative, but there's also a regulatory portion of it as well. And really the most significant act was passed back in the 1970s, which is known as ERISA, or the Employees Retirement Income Security. And really what that dictated was that boards and people who manage or who advise people on investing these assets have a governance and has a fiduciary responsibility. So while they may only be making recommendations and not necessarily investing the assets, they do have a duty to the clients. And they also have a duty, again, to those participants who rely on those assets in order to make sure that the assets are invested prudently and are invested within a mix of asset classes. That's really what's known as an all-weather type of portfolio. Now, it sounds all simple in order to do, but you'd be very surprised how many pension funds find themselves in trouble. So the most famous one, and they were not using an advisor such as Elijah, John, and myself to advise them, was back in 1994. Now, I'm sitting here in Los Angeles in Orange County, California. It's just a little bit south of me. What happened in 1994 is the treasurer at that point, he was an elected official and not an investment professional, did not have an outside advisor, was pitched this investment product by a Merrill Lynch broker. And the Merrill Lynch broker said, look at this rate of return. It's done extremely well, and it's done extremely well all through past periods. And what this investment wound up being was really a levered play or a way to have 105 or 110% of their assets within interest rate derivatives. And as long as interest rates were falling or remain low, this product would make a lot of money. Now, this product did do extremely well, and it did extremely well for 5 years. And so this treasurer looked like a genius, and he was gathering more assets, and more people were coming to him and said, hey, this town and municipality needs help with their investments. Can you help us invest? And he would. However, once those interest rates started creeping up to slowly, the drawdown effect was magnified by a rate of about 10 to 15%. And they wound up losing about 30% of their assets within 6 months. And that 30% of that assets was about $2 billion. Now, the county, again, has all these obligations that they need to fund and they need the assets for. They didn't have the assets to do it. And so they wound up declaring bankruptcy. And that occurred in 1994. Now, they were the largest municipality that declared bankruptcy all the way up into 2011. Since then, there's been a couple additional ones, but it really took them about 10 years to become more solvent. And they were finally able to pay off their last bill relating to this back in 2017. Now, while they lost only $2 billion, it was really because they didn't understand the exposures and the risks within their portfolio. They weren't being advised by someone such as myself, John, or Elijah in order to say, look, this is a great investment, work during this, but these are the risk controls that we need to put around it in order to make sure that it's prudently invested. Now, again, this is a time where a lot of other pension funds started looking at the risks and the exposures within their portfolio and started needing to be professionally advised and to understand it. And after that time period, that is really when we started to see the growth of investment professionals and investment consultants. Now, our expertise, as listed on this page, I want to first start with the governance of any plan. And the governance is first thinking about who's responsible for the decisions, who's going to implement those decisions. What is our return objective? What are we hoping to achieve? What is our risk objective? Once those are all documented and memorialized, not just for the current board, but for future generations, they have a framework about how they want to start investing the assets. Now, John, in just a few minutes, will detail how we work with clients in order to project out what their rate of return will be through an asset allocation process. But this asset allocation is really the second most important decision, the first most when it comes to investments that the plan will do. And the reason is this will account for close to 90% of their long-term investments. Once that decision is decided, from there, we start looking at the structure of really what's underneath the hood within each of those asset classes. So thinking about US equity, do they tend to have much more of a technology or growth bias? Again, thinking about in past periods, 2008, a lot of clients that I was working with at that point essentially said, why do we need anything else other than tech? And the reason why they did is those tech stocks wound up crashing by about 80 to 90%, really within a short-term period. So they weren't diversified, and that impacted their rate of return. In addition, it caused a huge loss of assets that took over 5 to 10 years in order to recover. From there, we're always thinking about the long-term outlook. Now, it's very easy to get caught in the short-term outlook, especially with what's happening today. But more focusing on the client. Look, we have these rules, we have these responsibilities, we have these obligations. So long-term, they're short-term. However, we shouldn't be making decisions based on what's hot today, because again, that could very much flip over very quickly. But thinking about the long-term, where do we see opportunities? Where do we think the markets will be going? Once we have that framework, we really see ourselves as an extension of staff. And that's much more in a qualitative aspect. So it's not just running scenario analysis and informing them about where the gaps and the holes are within their portfolio, but also advising them about the future. Where should we look for future opportunities? These days, we've talked to quite a few clients about crypto assets. None of them have been willing to pull the trigger, especially with the drawdown and the volatility they've experienced. But again, ask me again in 5 to 10 years, it could be a place where institutional clients have quite a bit of their assets parked into. Now for RVK, and this is our overview here. I'm going to first focus on the accounts by client type. Now at RVK, we're much more known as generalists. So we work with all types of institutional clients, from endowment and foundations. Reed College, for example, has an endowment that we advised at one point, all the way to corporate, as well as public pension plans. So for those of you that have parents that work for the government, most of them probably have a defined benefit pension plan that's being advised by a firm such as RVK. There are some firms out there that much more specialize. Either they specialized in one segment of the market, for example, endowment and foundations, and that's really all they work on, or they take more of, instead of looking across the multiple asset class products, saying, look, while we think US equities and fixed income are an area that needs to be invested on, there's certain areas of the market, for example, illiquid or alternative investments, such as private equity, where you need more specialization. You need someone who's an expert, who really understands what's under the hood, and also as a way in order to invest them. Now, there are investment consultants out there that just focus and specialize within those general areas of the marketplace. We here at RVK, again, we're much more generalist. Well, thinking about our expertise, we have quite a bit of breadth regarding the underlying asset classes, but we may not have as much depth as some of those individual specialists within it. Now, the key tenets of our culture, and I always think about Steve Jobs in terms of innovation, those firms that are able to innovate and grow are the ones that tend to be successful. And so if I was evaluating firms to look for, really my first question would be about what their growth plans are and how they plan to innovate and remain relevant as they look to grow in the future. But also thinking about client service or teamwork as I think about it. If more you're looking to go quickly, then it's something that should be done individually. If you're more looking to say, look, I want to be more thoughtful, I want to be able to really think about all aspects of it, working in teams baseball may not be as quick, may be a little bit more prudent. And so when we present ourselves to our clients, really these are the tenets that we focus on. Now for us, we do not offer any additional investment products. There are some firms out there that do. So we provide 100% unbiased advice, and 100% of our revenue is derived from our client satisfaction, our ability to grow either that relationship or have them recommend for us to be a trusted advisor for another plan. Now, again, as I mentioned, there's quite a bit of qualitative and quantitative analysis that goes into it, but we're very lucky to have a very diversified client base as can be seen on this page down here. Now, this is more a granular breakdown where we look at the type of clients. So again, also the plan types. Now, the plan types will be different depending on which client we're advising on. A defined benefit plan, really someone's made a promise that they will give you X amount of money in the future. They need to uphold that promise. As long as you continue to work for them, they have to pay you at the end of the day. Or a participant-led defined contribution, a 401k plan, which I'm sure either you've been a part of through a part-time job or that your parents are members of now, which much more the individual is responsible for funding their retirement. But also, again, as I mentioned, endowment and foundations, as well as the health and welfare. Now I see there's one question. If you want to give me 1 second. So it looks like someone has their hand raised. If you want to go ahead and unmute yourself and ask your question.
Oh, sorry. I thought you meant a second to finish what you were saying. So my question was, earlier you noted that your firm is like unbiased, provides unbiased advice with no conflict of interest, and that a lot of basically all the money gets made just from them deepening that relationship or recommending you to other people. What's the alternative? Like, are there firms that market themselves giving biased advice, or what does that look like alternative models?
Yeah, so I would say everyone gives their best advice. To use an example, I previously worked for a firm, and that firm also offered investment products. And so when I talked to a client, I was given a commission if I was able to recommend and have that client invest within that product. So for example, at times the conversation would not necessarily be me relying on someone like Elijah for a fixed income product. I'd say, look, we also manage this product here. This is why I think it may be appropriate for you. Now, at times, the appropriateness may be on a scale of 1 to 100, maybe 80 to 85%. But we would still go in there and talk about it and say, look, again, there are alternatives, but this is why it may be the best one for you.
Yeah, another good example is on the manager research side where I sit. I'm specifically a fixed income manager research analyst. And so because I don't work on commission, I have no problem saying fixed income is going to be very challenged looking forward, and you might want to rebalance away from fixed income, depending on who we're speaking to. So there's no pressure to potentially say, well, you want to stick with fixed income because that's where I work, and I want you to have more fixed income. Because we don't have that commission, we don't have that incentive.
Now, before I hand it off to John, let me just touch upon one point. So with our clients, it always comes down though to investment returns. And as I mentioned earlier, it's more trying to focus on the implications of the short-term performance and how that influences long-term performance. So thinking about the most recent current events, and really our hearts go out to everyone who's impacted and been affected, but it's our responsibility to think about those implications. Now, I personally, and I'm sure John and Elijah have too, have had quite a few clients who are panicking, who are looking at the calendar year to date return, the S&P 500, which is down about 9%. This is actually 2 days ago. So it's actually probably down about 10%, even though the market's up today, and saying, just make the pain stop. We are losing money. I'm getting questions from my investors. I just think we need to move out of these risk assets. At the same time, if they do that, it's always the sell at a low time and buy at a high time. It's more focusing the clients and thinking about, look, let's think about those long-term implications. So again, thinking over the past 5 years, if you kept every single dollar in there, you would have had another $1.50. So you would be returning about 2.5%. So again, it's a way to frame the conversation, and it's a way to say, look, we want to understand implications, but we also need to take a long-term view. So while it's not highlighted here, over the past 10 years, the S&P or the growth assets have returned well over 15%, much more than a higher rate of return than what clients need to earn in order to remain fully funded. Now, we're always cognizant of what those valuations look like, which is on the next page. So we do look at the quantitative analysis of where the market is going and what's being priced in besides what's occurred before. And all that's factored within our asset allocation process. So from here, I'm going to turn it over to John, who's going to talk about, again, the asset allocation research, as well as the process we use to work with our clients.
Sure. And I guess I could share a screen potentially, if that works. Just give me 1 second. Okay, can everyone see my screen okay? Okay. All right, so yeah, so I think as Jason mentioned, I'm going to be concepts that kind of guide our presentation and also our business. Without further ado, I'll just dive in. So I think it's helpful to think of asset allocation in terms of some of the studies that have been done and some of the research that's been done over the years. So like we drew, so the concept of asset allocation draws from a number of different sources. And what we found is that, 100% asset allocation explains 100% of the return amount over time, and it explains 90% of the variability over time. So in essence, asset allocation is one of the guiding forces behind what makes a portfolio successful in the long run. I think like one important point to mention is just that, while an individual manager can sometimes perform poorly, if you have a diversified enough portfolio, and you're allocated to a number of different managers, then you can, in effect, minimize and mitigate that risk that comes from that one poorly performing manager. So even though there may be bumps along the way, because you have this strategic asset allocation, you should be good for the long run. Okay. And then the next slide. So another part of the research shows that, when you have volatility, meaning that if your portfolio goes up and down more often rather than like a steady increase in asset values, the numbers show that over time the returns are actually better. So you see here in this graph, we have portfolio 1, 2, and 3. And for portfolio 1, it's just a constant steady increase of 5% growth over year. over a 20-year period. And then for portfolio 2, you have it staggered between 0 and 10%. So on average, it's still a 5% return, but as there's a standard deviation of roughly 5%. So meaning that like 10% is like roughly about 5% more than the 5% average. So as you can see, when volatility increases, you'll see on the graph on the right that the blue is actually lower than the over time. So you see like, so obviously if you're talking about like actual dollar amounts, then it's not that much, but if you're talking about like billions or even hundreds of millions of dollars, this could have a really big impact on your portfolio. And yeah, so and as you know, and you can also notice that like for portfolio 3, it's like an even wider standard deviation. So like 15 versus swinging from -5 to 15%, that actually performs the worst of the 3. So I guess another part of asset allocation is you have to consider the different the profile of the investment profile of the individual investor. And this is true of whether it's a retail investor or an institutional investor like a college endowment. You know, like you have to consider what are the objectives? Are you trying to return like 5% a year? And in terms of risk, you want to consider like how much tolerance you have for that risk. So if you have a higher risk tolerance, then you might be willing to invest in more riskier assets like venture capital or and be able to get a much higher return in the long run, but also you might see more ups and downs in the long run. And then there's other considerations, like I think taxes are important for a lot of different clients out there, as well as liquidity. Like if you need to make cash payments for your pension fund, then liquidity is another factor that comes into that. And so generally we like to group the different asset classes out there into these 4 categories. So the first one is like capital appreciation. So we have like stocks, you know, real estate to an extent. And for capital preservation, it's more like you're trying to minimize the downside in your returns. So you're talking about like bonds, generally more stable investments. And then there's also like inflation asset classes as well, inflation protection asset classes. So you might have like commodities, like because inflation tends to increase commodity prices, you'll see that like if you're invested in commodities, then you move up and down alongside the increases in inflation. Yeah, and then lastly, there's alpha-based asset classes. So like hedge funds typically get into this would fit into this category, trying to get like consistently marginally higher returns than inflation or like some other benchmark. So moving on. So how do we come up with asset allocation? This is an important question, and generally we look at 3 different things that go into our assumptions before we try to come up with potential model portfolios. So in terms of, we'll look at return, risk, and correlation. So return is pretty straightforward. Like it's probably the first thing that you'll think of in terms of like looking at an asset class. Like, is it actually performing, meeting your expectations in terms of performance? In terms of risk, it comes back to that idea of volatility that we were talking about earlier, and trying to provide as smooth of a ride as you can to get to your destination. And then correlation is probably the least intuitive of the 3, but you want to consider like when you look at when you try to diversify your portfolio, correlation is important because if you have like let's say stocks do well in one environment and bonds do worse in another environment. They kind of like complement each other in different market environments. So you'll want to think of all three of these things when we come up with our capital markets assumptions for each asset class. So here you'll see risk and return plotted out in a sort of a visual. So as you can see, like cash is on the bottom left, and that one's probably like as safe as it can go, but also the least amount of return or potential for return. And then you have like private equity and like real estate up in the other end of the spectrum. And even stocks are they're in the middle, but they're closer to the top right. So yeah. And I'll just run through an example really quickly. So in terms of asset allocation, we like to plot different model portfolios on through a program called MPI Stylus. It's a mean variance optimization software, which basically plots like 10 model portfolios on a graph based on the risk and return profiles. And these are supposed to be the most efficient portfolios out there based on your constraints. So you have a target mix here, and then you'll try to see like where your portfolio stands compared to the other 10 model portfolios. So yeah, that's kind of like a high level on this example. And you'll see it plot them. This is like a graphical representation of just like basically what I just described. So I guess, yeah, this is a good example. This is my last slide. And basically I'll be talking about, I just wanted to highlight that when you have asset classes with different levels of correlation, it affects the overall standard deviation or risk of the portfolio. So if you look at portfolio one, A and B are like pretty correlated. So for those of you who may not have as much of a statistical background, a correlation of 1 means you're moving almost in sync. Whereas if it's like 0, that means they kind of don't have any relationship with each other. And the -1 would be like the other end of the spectrum where it's like complete opposite performance. So in portfolio one, we have a 0.9 correlation. And that gives you a risk of 10%. Meanwhile, with portfolio two, because the correlation is closer to 0 and is lower, that brings down the risk profile of portfolio two. Even though if you look at the individual asset classes A and B, you'll notice that the standard deviation is a little higher for both. So yeah, so that's how correlation fits in terms of like from a mathematical standpoint. I think that should be it. I'll pass it on to Elijah.
Yeah, great. All right, can you guys see my screen? Okay, cool. So yeah, so I work in manager research here at RVK, and as I mentioned, you can go general consulting route or the manager research route. What is manager research at a high level? Well, when I say manager, I'm typically referring to an asset manager. So these are firms or teams managing assets where they have some sort of specific philosophy and process and specific asset class that they focus on. There are managers who, manage assets in private equity or private credit or public assets such as public stock or public fixed income, or alternatives such as multi-asset or real assets such as real estate. So there's a whole broad swath of different asset classes out there, and therefore there's a whole broad swath of different types of managers out there. So we have a broad manager research team that consists of individuals who specialize in a particular asset class and will work on covering that particular asset class, and sometimes have dedicated sub-sectors that they particularly cover. So you can see we have an equity team, fixed income team, alternatives, and then some specialty resources. Specialty resources under there, you see Sonia, she's our ESG specialist. I don't know if you guys have heard of ESG before. Not really? Okay, well, you might if you're interested in finance and if you're looking to go into the industry. Environmental, social, and governance, that's what that stands for. And it's certainly a trend that we're seeing where more and more clients are asking about, maybe not only what is my portfolio returning, but what good is it doing, or how does it align with my core values or beliefs and such. So that's kind of what that's getting at. And Sonia really leads that effort. So myself, you can see that I'm on the fixed income team, and specifically I'll cover things like stable value or core plus or core emerging markets debt unconstrained. You might not have heard of some of those sectors. Core, that's kind of a vague term. It's just referring to a investment grade liquid portion of the fixed income market, corporate bonds, treasuries, and mortgage-backed securities that in a third, that's typically what that's referring to. Stable value, that's like fixed income that's wrapped by insurance. So it's actually pretty interesting, but it's specific to retirement plans. And then unconstrained, that's just managers who have broad discretion over what they can invest in. So they might invest in multiple areas of fixed income, such as public and private, or emerging market debt, investment grade credit, high yield credit, bank loans, all sectors they might invest in. That's what that's referring to. So, and then we have other members on the team, Erin and Austin, who oversees the team. And she also oversees the private team, which includes, Justin and some of the other members. So that's kind of the broad team. We're a resource to consultants and a resource to clients. So I basically have 10 to 20 bosses where consultants can reach out with questions, clients can reach out with questions. It can be anything from a search where they want to fill a certain mandate. A client wants a bank loan manager, so they reach out asking for, who's the best bank loan manager, or who do you recommend? Or it could be a client service team member reaching out for educational materials on an asset class, or just an opinion on a benchmark or a guideline, or anything and everything. So that's essentially what we do. How do we think about managers? How do we evaluate them? It's a pretty interesting part of the job, kind of like you guys. I've been stuck in my home for the last 2 years. So part of the job typically includes travel. So consultants, as you can imagine, travel quite a bit to meet with clients and go to all their meetings. On the research side, we travel a little bit less, but we'll still travel to meet with managers on site, or go to client presentations and review their portfolio, or discuss a particular opportunity. So when we're with them in person, we'll go through something like what you see here, or when we meet with them during our regular due diligence, which can be quarterly or semi-annual, or different periods. So we'll speak on the firm and the team, the process, performance, product, assets. We're looking for stability. We're looking for consistency. We're looking for a firm and a team that aligns with what they're proposing. So if they say, we're a top-down fixed income asset manager, we look at macro themes, we look at economics, we look at GDP, we look at the job market, we look at all these macro trends to determine where we want to invest, but they don't have any economists, or they don't have someone with a background in that area. Someone, maybe their background's in bottom-up due diligence. That would be kind of a misalignment. That's something that we would spot and want to address. So we want a firm and a team that's consistent, that have the resources and the capabilities to support the products that they're investing in, and that align with the asset class that they're investing in, and have the track record to show their ability to deliver and deliver consistently, and that they have the assets likewise to properly run the strategy that they're proposing. And then how do we think about all this stuff when we speak with the manager? We have internal rankings that will apply, positive, neutral, negative research. And this is just a way to kind of classify the managers and bucket them so that we can more easily convey that to clients. But it's not really a strict buy list or a sell list. We really customize to the client. So some other consultants might have a list where you just have to get on the list and then you're approved and then you're pushed out to clients. That's not really how we operate. We have various managers that we may view positively, but maybe we only view them positively for a particular client type or for a particular strategy. And as those strategies or as those opportunities come up, then we can work with clients and with the manager to evaluate that. But it's very fluid on what the client is looking for. So manager selection, this is just kind of an overview of the process, starting with establishing criteria. You can see the first thing we look at is asset allocation and the client objectives. And so that's the most important step. You know, we don't say, oh, here's a great high yield manager. Who can we shove this high yield manager to? It's working with the client on what's their asset allocation, what are their objectives, what do they need? And if a high yield manager fits into that slot, then it's going through the process of the quantitative and the qualitative analysis that we do, an in-person or virtual on-site visit these days, and then, manager selection. So that's kind of the manager search process. And then we do ongoing monitoring where we meet with managers regularly and discuss everything I discussed before, team and strategy and philosophy and process, track record and all that. And we do that regularly to stay abreast of what they're returning and what they're doing and what their outlook kind of is. So perpetual due diligence, this speaks to that again. Just a few stats on, you can see 5-year average, we're placing 17 billion assets. That's pretty high. And so that enables us to have quite a bit of access to managers. If I call a manager and want to speak to their portfolio manager or their analysts or do a walkthrough of their capabilities or their back office support or anything along those lines, we have that access, and managers will work with us and know that we have kind of the breadth of our client base, and they'll want to work with us and give us as much information as they can, which makes our job a little bit easier. And it also speaks to kind of how much we cover. You saw we have an equity team and a fixed income team and an alts team, and just that amount of assets that we're placing, that kind of speaks to how broad it is and why we need so many researchers. And then this is kind of just another overview of the manager research process. We can just kind of skip that. And then emerging manager programs. This is another theme or trend that we're monitoring and is kind of ongoing. If you're in the industry, you might hear about it. Emerging managers, it could be anything from a manager that's diverse and diversity owned, greater than 50% minority owned, or a manager that's small in size and is trying to break into the market. Maybe it's not diversely owned, but it's still a small manager with a low AUM or assets under management. And so there are some clients out there who have specific emerging manager programs, and they're looking to give these managers an opportunity that they might not otherwise get because maybe they're getting crowded out by the bigger players in the market. So it's something that has become increasingly important, and we've seen more and more clients kind of bring it up, and we speak with more and more clients about it. And there's just a few stats here on how many emerging managers we funded or worked with, and you can see it's fairly broad. So that's pretty much an overview of manager research and how we work with the different teams and the services that we provide. I didn't really go through my day-to-day, but it's very different. It can be anything from manager searches like what you see here, where we look at various managers and help clients look through their statistics and their performance and help them kind of think about what they're seeing, and then putting forward a recommendation or discussing options with them. It could be putting together a recommendation memo. It could be, like I said, discussing the market or educational pieces on a particular sector or anything along those lines. So it's pretty broad. this is an example of a manager search. It just shows some of what we look at. There's a few managers listed here, and you can see, well, I don't know, maybe not, I don't know, but one of them is a passive manager. The others are active. You can see it has index in the name. This would be a core fixed income search. So this would be like what I said, treasuries, corporate bonds, investment grade, mortgage-backed securities, typically, at least that's what's in the index. And so here's an example of some simple, a snapshot of characteristics as of 2021. So for these managers, okay, they're all pretty high quality, AA. Coupon, here's what you're yielding. It's not crazy high. Now is a very low yielding environment. Rates are very low. So clients aren't generating a lot of yield in their portfolio. And that's a big challenge because they have certain demands on them. And so another big theme and trend that we're dealing with right now is how to enhance yield or how to ensure that yield in client portfolios is robust without taking on unforeseen or unnecessary risk, in the form of duration or interest rate risk. And then, yield to maturity, average maturity, effective duration. There's your interest rate sensitivity. And you can see for core, it's pretty high. Also a challenge for core. Here's a snapshot of allocation data. So just showing what these managers own. So compared to the index, you can see there's the passive manager will really hug that index. Some of these managers choose to take some non-US exposure, or they'll take more credit exposure or more mortgage-backed security exposure. And that's based on what they think is providing relative value, what they think is beneficial, and what will set them up to outperform on an absolute basis and relative basis. And then here's just a sample of some performance that we look at. You can see here's trailing performance. This isn't the only thing you want to look at. You don't want to just look at the track record and say, well, Dodge and Cox has outperformed over 5, 7, and 10 years compared to this core fixed income search. So just go with them. You also want to look at consistency, and you want to question, why are they generating that performance? Is it because they're leaning into something like, high yield and taking on more credit risk? And is that something you want in your liquid, downside protecting core portfolio? Is this more of a core plus-ish manager? And how do we think about that? So here's an example of how we might address that. Consistency over time, just looking at the same time period, but going back several years. And then some MPT stats, looking at Sharpe ratio, information ratio, what kind of excess return they're generating on a risk-adjusted basis. And that's pretty much it as far as the manager research side of things. I'm curious if there's any questions, or if any of you guys, I don't think we asked in the beginning, but is anyone here majoring in finance, or is this, at all related to anything you guys are interested in?
I don't think Reed has a finance major. I think we have econ, and then we have environmental econ, or ES econ. I think it's like environmental science econ, and econ, which is sort of math econ.
Are any of you econ majors, or okay, econ major?
So
yeah, any questions?
I'll just mention, as in my previous firm, I did a lot of hiring in the entry level position, and really similar at RVK, we had what's known as a performance measurement group. And really, it's much more of a standardized as a way just to gain some industry knowledge, some industry exposure, kind of get your feet wet. But RVK and most investment consulting firms tend to look to recent graduates to fulfill that role. The idea of, look, let's get them in. Hopefully they have some sort of quantitative knowledge, either through their major or just through intellectual curiosity, someone who's interested in either a quantitative major, as Elijah just mentioned with manager research, a little bit more qualitative to present those research to the clients. So there's a wide range of possibilities and outcomes. And again, we're thrilled to be here. And please, are there any questions we could answer?
Yeah, they don't have to be specific to the presentation. If you have questions on, I don't know, our background or the market or, something you've heard that is related to finance that you had a question about, feel free to shout it out.
Yeah, and to Jason's point, I think we are like hiring for an investment analyst position right now. So that's of interest. Yeah.
I guess a question that I'd like to ask is, what's your favorite thing about the job and what's the most challenging thing about the job?
Yeah, sure. Yeah, I'll start. Favorite thing about the job, continuous education. So I always have to learn more about, some part of the market or some new strategy. So it's never kind of dull or mundane. It's not like I do the exact same thing every single day. And I get sick of it because it's always challenging. On the flip side of that, it can also be, I suppose it's challenging to always learn on your feet, and that it's important to stay abreast of the market and stay on top of what clients are asking about. And so it puts more of the burden on you to really, I guess, stay on your toes and always make sure that you're plugged into what's going on. But yeah, I'd say that's pretty much it. John?
Yeah, I think like in terms of client exposure, like you get exposed to a lot of different client types, as Jason was mentioning earlier in the presentation. Like I'm like an investment associate and like I'm on a few different client service teams, like roughly 8 to 10. But as an analyst, you get exposure to like 30 different, like 20 to 30 client teams. So like there's really a lot of exposure, and like you'll see the full spectrum of institutional investors. And I guess like one part that can be challenging is like in my role, there's a little more special projects. So like I noticed that some of you guys like had some experience with like spreadsheets and also like coding languages, like from looking at some of the resumes. And like I noticed, so I know from my experience, like I've like I'd work a lot in like Excel and like Power Pivot, like creating pivot tables and using different Excel formulas. And like RVK has given me opportunities to explore like some other skill sets and different programs like Access for databases, and it's been interesting. So yeah.
So I'll just mention to conclude, what I enjoy most is I feel like I have a lot of breadth of knowledge. And by breadth, really working across the asset class spectrum, from working with clients in equities, fixed income, alternative investments, including education on crypto assets, private real estate. I could pretty much go down probably 30 or 40 different asset classes that clients have asked me about, or we've had either a formal presentation or informal presentation. I would say on the flip side, the one thing that I've always found challenging is the depth of knowledge. So again, by having all that breadth of knowledge, you're pretty much like this far below the surface at times. Whereas talking more to some of my colleagues who are more focused on one segment of the market, their knowledge is much more, they're probably a mile deep. So while I could necessarily start a conversation if someone really wanted to go down into the weeds and really wanted to understand, for example, all the nuances of core bonds, at that point, I'd need to loop in someone like Elijah, who has much more of that expertise. But again, I also do enjoy, though, having that breadth of knowledge. So being able to talk about equities, alternatives, credit, what's occurring in the marketplace, either in the current and the future, just at times I wish I had a little bit more depth to it.
Yeah, actually, another thing I'll throw out there, and I think this is something particularly important for new graduates or people kind of in that phase, organization, and making sure that you're able to, I guess, yeah, just organization in general. Wherever you go, even if it's not in finance necessarily, you'll likely have several demands on your time and constant requests, and it's important to make sure that you're able to stay on top of that kind of stuff. And it only sets you up for success if you're as organized as you can be. So I would just promote that. Great. Any other questions?
I guess, well, I don't know if it's time to actually go over this, but you offered to kind of discuss your backgrounds. I am generally curious how you ended up, I guess, where you are, not just like what your major was, but, did you go into finance right after graduation, or did you go to grad school, stuff like that?
So I went from, I pretty much majored in finance right away at Oregon State. I knew I was interested in that. And then it was the thing about finance is it's pretty broad. There's a lot of different jobs you can have. You could go into, into investment banking, or into asset management, or into corporate finance, where you're, working for an individual company and helping them with their internal finances. You could go into consulting that relates to corporate finance. So kind of like in our role, but specific to corporate finance. You could do investment consulting, what we do, where you're a consultant, but to clients based and helping them with investment management. So it's pretty broad, and that just scratches the surface. So I think it took a while to figure out what I wanted to do. And kind of like I said, I sort of stumbled across RVK because it's based in Portland, so it's local. And I think I went to a career day, and that might have been the first time I heard about RVK and what they do. And then it was just a matter of, looking across the different types of jobs and what they offered, and what I kind of wanted my career to look like. And the thing is, early on, it's hard to say what that is. And so the nice thing about RVK is that the work is broad as a consultant. So you get exposure to different asset classes, you get exposure to I get to work with a bunch of different firms every day and learn more and more about them. And so I think it was a really good training opportunity, because you learn a lot about the market and kind of the overall finance, I guess, economy, or there's a better word for it, but you get a lot of good breadth and a lot of good training. So that's kind of what initially attracted me, I would say.
Yeah,
So
I think for me, I'll go first. I think as far as my own experience, I'm pretty fresh out of college, but grad schools, I know you mentioned grad school is one particular track. And I know a lot of us, like Elijah and Jason included, like Jason has a CFA. And for those of you who aren't familiar, this is one of the ways of continuing your education in investments. So it stands for the Chartered Financial Analyst Program, and maybe Jason can talk about that a little more. But I think it's a good way to stay abreast of, stay on top of the knowledge that's happening within the industry.
So I know we're almost at 10. I'll just say this. I said yes to every single time an opportunity was presented in front of me. It didn't really matter what it was. My only question is, hey, was it interested in, do I think I can add something to the conversation? And through that, I kind of fell into institutional consulting, because I remember being 25 in front of a $10 billion pension fund. My boss at that point was sick, was not at the meeting, and they had to make a major decision about an asset manager they were going to fire. And so they turned to me and said, hey, what do you think? And I'm thinking to myself, this 50-year-old guy is asking me. And so I gave him what I thought was my honest opinion. And I said, hey, I think this, and this. He goes, sounds good. This is what I recommend. And so I walked out of there thinking to myself, that was pretty cool. I was able to influence some decision. I was able to present a case, and I was able to effectively communicate it. So then I came back and said, okay, I like this. What should I do next? And then eventually I fell into institutional consulting from there. Well, I know we're out of time. So again, thank you all very much for attending today. Hopefully we gave you a little bit of a taste of what institutional consulting's like. I know it was quite a bit of information thrown at you. Again, feel free to reach out to myself, to John, to Elijah, if you do have any more questions, or if you just simply want to stay in touch. We look forward to interacting with you at some point down the line, and we wish you the best of luck. So thank you again, everyone.